the impact of any of change in the political dispensation, right? Because we'll definitely feel the impact regardless of whoever take over the mantle of leadership in Nigeria. So I think at this point, I would hand over to my colleague, Shekinah, to take us through the rest of the webinar. And my other colleagues also will be talking about providing research context about some of these happenings that have happened, that have occurred, and how we can effectively position ourselves. We would also be talking about investment solutions that at ARM would help you to weather some of the storms that are up ahead. And some of these uncertainties have already crystallized, while we expect some of these uncertainties to occur in the nearest future. So thank you everyone for joining once again, and we'll ensure that we make best use of the time. Thank you.
Thank you, Joshua. I think that was just a wonderful opener to the conversation we're going to be having today. But briefly, before we move into the presentations proper, we'll just give a minute for everyone to quickly fill out the polls that will be coming up on your screen in a second. All right, thank you for taking the time. So moving into the main agenda for today. The topic for today's webinar is navigating investment opportunities amidst increased uncertainties. And I have with me a few colleagues who will be demystifying this topic. Firstly, we have Ayodeji Ajilore, Senior Research Analyst with ARM Securities. And then secondly, we have Oluwamayowa Obebo, Equity and Fixed Income Sales. Ayodeji, you can take the floor
now. Thank you, Secretary. Pretty much a great opportunity to be here. And then, of course, like Joshua said earlier, the context of this conversation is born out of the desire, right, to actually help our investors to chart a new, different, and very strategic path as they navigate the current uncertainties within the global and then of the local market. So in a real sense, right, the conversation is still very much prominent. And then of course, when we say it, it seems like we are rehashing what we have said in the past, or perhaps say, rehashing what we've spoken to in the past. 2021 was a very important year for the global economy because it actually is a year whereby the global economy would eventually be clear about the path it wants to take immediately after the issue that we had, particularly with the emergence of the COVID-19 virus in late 2019, and then of course, early 2020, that is still very much with us till today. So basically in 2021, the global economy recorded some gains, and then it goes without saying that we would expect, otherwise have expected that that trajectory will continue. However, what was obtainable, right, at the beginning of the year shows that we wouldn't or we shouldn't expect that particular growth trajectory to continue. Why is that so? It is so because we actually had some underlying concerns that were still prominent at that point. Of course, we saw so many mutations of the virus already, I think in excess of 3 or 4. And then, of course, there are still mutations of the virus going on globally. Let's take, for instance, right? Currently, as we speak, there is lockdown in Shanghai, China, and basically that is predicated on the need to curb the transfer of the virus after we are seeing the issue re-emerge within that space. So that actually bettered the kind of forecast we had, particularly for majority of the time then in January, where we saw expectation taper. However, on the aftermath of that, we've seen a new tune to the conversation. And that new tune is now predicated on the fact that in February, we saw Russia invade Ukraine in what is now an all-out war between the two countries. So that has severe consequences on the global economy. And then from what we saw and what we are currently seeing, right, it is more to speak to the fact that this war is still in existence as we speak, it still continues as we speak, and it doesn't seem to be abating anytime soon. So basically in that light, we've seen new twists to the growth story. And these new twists are coming in the sense of perhaps we can see now the World Economic Outlook in April spoke to the fact that the US economy is expected now to grow at 3.7%. We saw the same twist to EU, same twist to UK, and then of course Japan, and of course the global expectation for growth as well. So moving forward, we actually decided to evaluate this reality in the context of what is happening in the market, which led us to looking at the Purchasing Managers Index, which is actually an index that gives an indication or that leads us to know what the pulse of the global economy is or the economic concern is. So going to the PMI now, the next slide, please. Going to the PMI conversation, we saw that what looked like a very great expansion, like we saw in early 2021, is now abating. And then basically that energy is weakening because there are concerns that are starting to emerge. Hence, the conversation around readjusting growth expectation, particularly for 2022, is valid. Next slide, please. Now, one of the major issues, right, that actually is a backdrop of what happened or what is happening between Russia and Ukraine is the fact that international energy market is getting a hit. I mean, especially from the supply angle. Speaking of the supply angle, Russia is an important supplier within that space. And then seeing as the sanction being meted as a result of its invasion of Ukraine, right, is taking effect. I mean, globally, prices of crude oil, for instance, is rising, both in the futures and of course the spot market. The attendant implication of this, next slide, please. The attendant implication of this can be seen easily on how energy prices have spiked prices of commodities, consumer prices across economies of the world. As of March 2022, we were able to pinpoint that the US economy consumer price index actually peaked at 8.5%, the highest in almost 42 years. And then looking at the current release of the World Economic Outlook in April, right? Forecast for 2022 has since been adjusted to 7.7%. Really, this is a very challenging time for the global economy. Do not forget also that it is not limited to that economy, I mean the US economy. We have also seen it spiral into the euro area due to its energy dependence on Russia as we speak. And then, of course, in the absence of alternative, prices can only keep peaking. And then, in the real sense, only some actions by monetary authorities can weaken this energy, but we do not necessarily believe that it can control it to the downside significantly. Next slide, please. So we decide actually to check the policy framework in place, what we expect with respect to monetary and fiscal policy. And then, of course, it is worthy of note that since late last year, the US Fed has actually been talking about the need to hike rates. And that was based at that point on the fact that we continue to see, and what we continue to see is that prices continue to rise. And then at that point, at some point, it was ascribed to transitionary issues from the series of intervention that took place in the course of mitigating the effect of coronavirus on aggregate demand globally. And then, of course, in the US economy, we saw a lot of quantitative easing activities. We saw a lot of bond buying activities, which actually culminated in significant liquidity within that market. Yes, this year, we've seen a hike in rate, but we still expect further hikes in rate. So basically, the point is the US will continue to hike rates, and then we expect 6 further hikes, for example, for 2022. Eurozone also has been visited with this reality. Same can be said of the United Kingdom, particularly. And then, of course, other economies in emerging markets. Although it must be stated that we have yet to see a hike in the Nigerian space, which we will touch base with very soon. So in the fiscal space, right, the overriding conversation now is more about balancing, having a balance between revenue generation and then, of course, ensuring debt sustainability, which affect investors' confidence. We've seen that majority of this economy have had to call investors' meeting to clarify the course of action that they intend to take. We've seen same with Ghana. And of course, one way or the other, we've also seen the Federal Ministry of Finance here coming out to address concerns about our debt level. So for the outlook, ordinarily, we would expect at this point that all economies of the world are taking a pro-growth stance. I mean, a stance that is more towards ensuring that the current normalization in aggregate economic activities is sustained. But seeing the level of the magnitude of uptrend in consumer prices, there's a need to find a balance between taking a growth stand and then, of course, combating concerns of likely hyperinflation. And then, of course, in the real sense, we can also speak that this would have effect, significant effect on economies that actually still are driven by importation, especially emerging market economies. The next slide, please. So to provide color to the old conversation, in 2021, it goes without saying that the global capital market witnessed an outstanding year. We saw performances from the US even to emerging markets, showing that investors have significant liquidity to play with. However, no matter the level of liquidity, we have observed that whenever there are concerns about interest rate direction, investors will usually pick safety pending when the coast is clear. And that is synonymous, particularly, to what we have seen so far in the global capital market. As of Q1 2022, the end of Q1 2022, we saw, that most of the activities in the market shows that gold is actually the top gainer. I mean, gains are driving towards commodities that provide some level of safety. Next slide, please. So looking at the context created by the global realities and the existing local concerns, we think we should reflect that in what we expect for the domestic economy. And based on the recently released World Economic Outlook for April, like I've stated over time on this webinar, the IMF has revised Nigeria's growth rate to 3.4%. Central Bank of Nigeria is still yet to change from its position of a 3.2% upside. And then, of course, the CBN position is based on the belief that the current global economy reality, in the light of the subsidy regime in Nigeria, does not necessarily change much. In our case, however, we think those two views are optimistic. And then we think, in our case, they might be overly optimistic. So we still retain our growth projection of 2.6% for 2022 financial year. For additional coloration of the conversation, we've seen that one of the issues, that the IMF spoke to as the basis upon which it did an upward revision of the Nigerian growth prospect for 2022 is the fact that the oil sector, the rising oil prices, would create an opportunity for the economy to post decent growth. We, however, hold a position that suggests that seeing the current issues around oil production in Nigeria, that the current trajectory in price might amount to not so much. So overall, that informed our decision of maintaining our growth prospect at 2.6%. Now, based on sector, we did a sectoral analysis of what we think would impact growth direction this year. Of course, we expect agriculture to continue to post moderate growth, and that is basically as a result of the fact that we continue to have issues around insecurities. And then, of course, most people are having to vacate their farm as a result of that. And then, of course, the crude oil, we expect some moderate adjustment. And the crude oil and natural gas space, we expect some moderate adjustment. And then that is basically on the fact that the prices has improved. But the volume issue is still an underlying downside to that overall outlook. So in the real sense, the aggregation of all of these positions, right, helped us to arrive at a 2.6% outlook for the year. Next slide, please. So now, alongside the growth concern, there is still the concern of rising prices. Although it might appear like we have turned the corner at some point last year. However, the reemergence of some certain factors have actually tilted the direction towards the north. For instance, we've seen the concerns around rising energy costs. And then, of course, we look at that implication on diesel. Because we actually focused on diesel because we felt the current subsidy regime, do not forget that recently there is this call for an additional budget of about 3.5 trillion Nigerian naira to augment the realities of fuel subsidy for 2022. So we felt, seeing that as that might be the case, as that is the case, pardon, the implication will be most likely felt on diesel, which will impact cost for manufacturing firms, and then of course, businesses that operate within the Nigerian client. So overall, these businesses might likely transfer this cost to the consumers or perhaps the users of their services, which indirectly creates price surge. And of course, we also have the surge in commodity prices, which is an aftermath, or let's say a backdrop of what is happening between Ukraine and Russia. And then we've seen maize and wheat continue to rise in price, continue to post a rise in prices. And then on another hand also is the complete removal of electricity subsidy. we have seen the NEC continue to review price of electricity tariff, or let me say the electricity tariff over time. And seeing the current realities in the market, right, that can only mean uptrend in the short to medium term. And then, of course, like I said earlier, economies that import some sizable material or say goods from outside. And then, of course, when there are inflationary concerns in the economy from where they import, there is a likelihood that imported inflation will be the case. So there will be inflation on imported goods and services, which means directly we also spike prices locally. As of March, the Nigerian economy has an headline inflation of 15.92%. The food index rose. Of course, we saw a softer rise in the core index. The point remains that the current trajectory can only tilt towards the upside. However, or let me say in addition, in our recently released inflation report, we spoke to the fact that inflation experience, it is personal. I mean, we have lifestyle inflation. In my case, what it is that it costs me to buy some certain necessities or perhaps goods that I consume last year is not the case this year. However, with other persons, it will also not be the same, but the difference might be in a different magnitude. So we think it is important that investors speak to their investment advisors so that a proper, or let me say detailed analysis of their inflation realities can be done. And then of course, the right investment vehicles advised or suggested. So for the monetary policy side of the conversation in the Nigerian climate, we expect unorthodox policies to persist. This is not new. It has been the case for quite a while. We expect that the CBN will continue to use various intervention funds, and as alluded by the CBN governor at the last MPC meeting, to boost economic growth. It has been the case all through the issues of the coronavirus, and we do not expect that to change. Also, we expect that constant CRR debit will still continue, especially with the level of the LDR as it is today. We also believe that there might be a little bit of uptick in MPR, which is the monetary policy rate, in H2. And we are basing that position on the fact that there may be a need for Nigeria or the Nigerian economy to remain competitive globally in attracting capital flow. We also note that there are some evident downside to that. Downside in the sense of the business environment, the insecurity, the infrastructure deficit, and of course, we actually believe that might just be about being addressed with the National Development Plan that is currently about to fully go into force. Another concern is that we believe that MPR might have lost its signaling effect. That so much that if there's a hike in H2, it might not necessarily mean that liquidity within the system will be tapered. It might not necessarily mean also that investment flow will be encouraged. On the other hand, however, that we think might adjust the direction of yield in the market in H2 2020, we have the concern around maturities. I mean, investment maturity, especially in the fixed income space. We also are looking at the likelihood of a thinner inflow to be dispersed through the FAAC system. Next slide, please. So like we cited earlier, we expect thinner maturity in H2. It's obvious from the securities on issue currently. And then of course, combining the effect of thinner maturities with the need for the federal government to plug growing budget deficit, right? There may be a need, right, for that hike to eventually happen, or the hike might eventually happen. We do not, however, take our view from the fact that the CBN might still just find its way to borrow off the market. And of course, like we have said earlier, hawkish monetary policy tone continues to reverberate around the global market. And then for us also, there is the issue of retention of capital flows. And then we think in the short to medium term, that might not necessarily change, seeing that we have said earlier also that the MPR might not change it. So next on the list is to talk to the strategy that we think might help us assuage most of this concern. And then of course, optimize investment portfolio that we currently are running. So we think, for one, that the equity space still portends opportunity. We also believe that the fixed income space holds opportunity. The same way, we think the alternative asset space still holds opportunity. However, we decided to be more specific. And then for the equity space, we think the oil and gas tickers are in a good place to help. Consumer goods firms, especially those that produces essential items and are able to transfer costs without hampering their volume. We also think the telecommunication space has proven its resilience. In addition, we think the recent approval of the PSB license for MTN might be an opportunity. And then of course, we expect the approval for the other player as well, which means that space, apart from proving its resilience, also is adding an economic unit that portends value. The same could be said of the agricultural sector. In the fixed income space, we expect that the play should be towards the short end of the curve. And that's largely because in the period of uncertainty, playing within a safe space where you have access to your liquidity as and when due is very key. We also noted exchange rate concern. Recently, we've seen the CBN continue to intervene, although sparsely, within the foreign exchange market in Nigeria. What the tone of the intervention has, however, shown us is that exchange rate concern is still prominent or should be prominent within the context of our conversation. Hence, we recommend that investors should look at Eurobond space. And then, of course, for those who are unable to pile the bulk needed to enter into that space, there may be a need to look at mutual fund that has Eurobond constituents. For the purpose of diversifying in portfolio, we think alternative assets are a good playground now. And then we think real estate is still one that is prominent within that conversation, especially for retail investors and high net worth individuals as well. We also believe that for those who might not be able to power the bulk in this case, there are mutual funds that actually has real estate investment as its constituent. So we think that place is a good place to look at. So overall, we believe that in any climate, in any macroeconomic climate, there are opportunities to thrive. And then we believe these plans, like we named them, actionable plans, are one of the best ways, or say the best way, to go about navigating the terrain. In this light, I would like to hand over the mic back to the moderator to handle the other part of the conversation. Thank you.
Thank you, Ayodeji. So we'll be progressing on to the next speaker now. That is Oluwamayowa Okebo. Mayowa, we could go?
Yeah.
Okay.
Thank you very much. Okay, thanks, Sekinat. Good morning, everyone. Thank you for taking out time to join this our conversation. Also, thank you, Ayodeji. That was pretty insightful. And you know, I'll just take it up from where you had stopped. You know, building a portfolio that can actually weather the storm. So ARM Securities as a full-fledged brokerage firm, primarily what we offer are equities brokerage and fixed income brokerage. And so like Ayodeji had said, there is that need to look inward between equities, fixed income, and also alternative assets, right? So we felt that it would be good if we also let you know about how you can products or services that can also help you in building a resilient portfolio. So speaking to equities, just like maybe most of us are aware, shares or stocks are equities, right? And these are type of securities that actually signifies ownership in a corporation or in a company, and you can lay claim on parts of the corporation assets or earnings. And the major advantage that equities actually have is capital growth and dividend. For some that's been playing the market for some times now, they'll be able to attest to this. You earn dividends annually once the company declares their full year financials, and then you also get capital growth once you see the tickers moving in a positive direction. So for with ARM Securities, right, equities trading is a minimum of €0. So that means with any amount that you have, right, you can actually invest with as low as 100 naira, 500, 1,000, any amount whatsoever. You can take advantage of equities and buy into stocks, your preferred stocks, or based on recommendations that you get. Then taking it down to fixed income. So the concept of fixed income, right, is fixed income basically on a general level are instruments that promises you a fixed return in the sense that once you invest in any of these instruments, you tend to get a fixed rate of income, say periodically, say quarterly, biannually, annually, or whatever it is, however it is that is being structured. So taking it down, we've been able to group them into 6. And then first off is the Fgn bond and the Fgn savings bond. So Fgn bonds or bonds generally are issued in exchange for cash, or generally fixed income instruments, right, are issued in exchange for cash. Any fixed income instruments are generally issued in exchange for cash, then they will promise you a return in either interest or income. So the Fgn bond and savings bond are generally issued by that the state government or the federal government, and with a minimum of 5 million naira, you can actually invest in an Fgn bond. But the savings bond came up as an idea from the DMO, where they looked at the market and those that are in the retail space of the market, or those that are middle low income earners. And you can't just churn out 5 million naira for an investment, but you also want to invest in bonds. So the savings bond came up, and with as low as 5,000 naira, you can actually invest in a savings bond. Then also a corporate bond, right, is just synonymous to the standard Fgn bond. Is also issued by a corporate or institution in exchange for cash at any given interest rate and a repayment period. The minimum investment is 5 million, but this is not absolute. In some cases, we've seen ticket sizes above this. It's just based on what the institution itself is actually looking at. Then taking it down to Sukuk bond. The Fgn Sukuk is an ethical based non-interest based Sharia compliance investment, and the application, when we hear Sharia, we will look at it from our brothers or sisters in the Islamic faith, but this is not just for them. We all can take advantage of it, and the major difference between Sukuk and every other type of bond is that for a standard bond, you earn interest, but for Sukuk, you earn income because it's tied to a particular project. Sukuk are always tied to a project, and investing in that particular Sukuk or on offer gives you a part of it gives you a part of that particular project, so you can also lay claim to that project with your investment. And the minimum investment is a 2 million naira. And taking it down to Eurobond. Eurobond is any bond issued by a country or corporate in a currency different from the local currency. So we've seen Eurobond issued, I think sometimes this year, earlier this year, Nigeria also raised another Eurobond in the market. So it's not just government alone. We've seen corporates as well take advantage of the Eurobond space. And the minimum investment for this is the standard ticket size basically is a $200,000. But with the $50,000, we can source for opportunities in the market for investors, and they can also take advantage of this. Then we also want to talk about the commercial papers. So commercial papers are highly liquid short-term debt financing securities, maximum tenure of 270 days, and they promise decent returns on investment. So commercial papers are mostly raised by institutions who are looking to maybe diversify or expand, and they need funds. So maximum tenure of 270 days and with a minimum investment of 5 million. Sometimes also is not absolute, so it can be higher or it can be lower. But once we have any commercial paper on offer, you get an idea of what the minimum investment is. Then the last but not the least, which is the Treasury Bills, which I want to believe almost everyone on the call are used to. Treasury bills are risk-free, short-term obligations backed with the full faith of the federal government, and they have maturity of less than 1 year. So Treasury bills actually have 3 maturities at every time, or at every issuance, or at every maturity: the 91 days, the 182 days, and then the 364 days, which is the 1 year. So Treasury bills are issued every 2 weeks, so twice in a month, and with a minimum investment of $1 million, you can actually take advantage of this. Also just want to quickly point out to what Ayo had said. Going into the half year, the H2 2022, we expect linear maturities in the market. So we'll also want to look at that. We want investors to look into that space, because basically we've seen deficits in the budget, and government want to plug in those deficits. So fixed income instruments are actually some of the instruments that we can actually take advantage of. So then speaking to some of the services that we also offer at ARM Securities, research information is one of such. Stock recommendation, whatever it is that is happening in the market, and how we can quickly take advantage of that. You don't have to put in any funds to be able to have access to our research information. The only thing to it is you must be an ARM Securities client for you to have access to our mailing list and get this timely information. Then for equities administrative services, based on what we've seen over the years, we know people have shares, certificates stocked up somewhere, maybe in our wardrobes, in our files, in our folders, but we don't know what to do with them, right? You've checked up your name on the SEC website, you see that you have unclaimed dividends. You don't know what to do with them. You used to trade stock, but the stockbroker is no longer in existence. You don't know how to go about it. How about come around and talk to us? These are services that we actually do offer as well: dividend processing, dematerialization of shares or stock certificates, global search, and you don't have to pay any dime for most of these. You just have to be an ARM Securities client to have access to this offer. So just like Ayo has also said earlier, Ayo also mentioned mutual fund, maybe for some of our retail investors as well. And so I'll just quickly want to hand it over to Chinedu from our investment management subsidiaries, so that I can quickly speak to the mutual funds that we have on offer and how we fared over the years. Chinedu, please.
Thank you very much, Mayo. Okay, so I'll just delve straight into it. Speak about the concept of the mutual funds and the mutual funds that we offer here at ARM Investment Managers. So basically, a mutual fund is a pool of funds put together by investors or by people who have the same investment objective. And the fund is then managed by a fund manager, invested in different sectors of the economy. And the returns that are made, or the dividends that are made from these investments, are now passed down to the investors in question. So at ARM, we have 6 mutual funds that we offer to our clients, and I'll categorize these funds in 3 categories for the long term, medium to long term, and the short term category. And I'll start by talking about the aggressive growth fund. The aggressive growth fund, as the name implies, is aggressive in nature because it has about 75 to 100% of its assets invested in stocks, invested in equities. It's a long-term fund. We're talking about 10 years and above for investors who want to play in that space. You can start up that investment with 50,000 Naira and build up with 10,000 Naira on a monthly basis or at your own convenience. For the ARM Discovery Balance Fund, it's like the name implies, it's more balanced. It has its assets split into equities, fixed income, and real estate, just so that even when the equities market is not doing so well, the fund can stay afloat. The ethical fund is more of like a religious fund for investors who are particular about what sectors their investments go into. For investors who want their investments to align with their religious beliefs, that investment can be started with just 10,000 Naira and built up with 5,000 Naira on a monthly basis as well. The Eurobond fund is the only dollar-denominated mutual fund that we have at the moment. We started that fund in 2020, and you can start that with 1,000 USD. It's invested in short-term instruments and Eurobonds as well. The fixed income fund, which is the 5th fund that we have, we started that in 2020 as well. It's for retail investors who also want to play in the medium to long-term space. You can start that investment with 5,000 Naira and build up as often as you want as well. The money market fund is the only short-term fund that we have for retail investors who want to save up funds on a monthly basis or as often as they want to save up for. We advise people to actually tie this investment to whatever goals they have in mind that fall into the short-term category. We're looking at 6 months to 1 year for your savings, for house rents, for school fees, whatever it is you want to keep money aside for. Instead of leaving those funds in your regular savings or current account, you're making next to nothing on it. You can put it in the money market fund and get competitive returns as the case may be. So ARM has been into the fund management business since 1994, since the institution was established. And our fund managers have a wide range of experience, and we have our clients' interest at heart. It's about the clients first before anything else. So this next slide is just a snapshot of the performance of these funds in the last 5 years, the average performance of the funds in the last 5 years. From the snapshot, we can see that 2017 was a good year for the mutual funds, with all of the funds doing above 17%. And in the next year, 2018, the Aggressive Growth Fund and the Discovery Balance Fund ended that year in a negative position. But this does not defeat the aim or the objective of those funds, because those funds are for long-term investors. And there's always a tendency for those funds to rebound. And we saw that play out in 2020 and 2021 respectively, where those 2 funds finished or ended the year in a positive note at 15% for the Discovery Balance Fund and 18% for the Aggressive Growth Fund. Moving on to the Eurobond Fund and the Fixed Income Fund. Like I said, we kicked off those funds in 2020, and in the first year, the Eurobond Fund performed at 21% and the Fixed Income Fund at 11%. For 2021, those funds were in the negative position, and they're currently in the negative position this year as well in 2022. But we hope for that position to change between now and the end of the year. So that's it for the mutual fund. But also outside of the mutual funds, at ARM Investment Managers, we also help our clients take advantage of the commercial paper space for clients who are particular about fixed returns or getting fixed returns for a specified period. We also help them to tap into that opportunity. Those opportunities come up periodically within the course of the year. They're not available all year round, but when those opportunities come up, we can also help our clients to take advantage of those opportunities. That's it from me. So I'll hand over back to Sekina to round up. Thank you.
Thank you, Chinedu. Thank you, Maiwa. Thank you, Ayodiji. It was a great session, everyone. So real quick, we'll just have one last poll. We'll give a minute just like before. Please just take a second to just fill out one question. All right. So I think that's it in a minute now. So we'll just quickly move into the Q&A portion of this session. I will just quickly pop into the Q&A box and pick out the questions that we have. So we have, why would IMF review Nigeria's growth forecast upward when the world is almost going into a recession? Ayodeji, would you like to take that?
Yeah, so apologies. Basically, so what we are, I mean, based on their presentation, is particularly more about the fact that they think that the current direction, especially in international oil markets, would help take the oil segment, or let me say the oil sector, from the recent descent that it has recorded, particularly as it concerns growth in the economy. We've seen that over time, I mean, particularly for the larger chunk of last year, the crude oil space was not necessarily posting any growth, right? So basically, they expect that these price issues now will leave a legroom or more legroom for the sector to leave that space and, of course, post growth. So basically, that informed the direction. However, like I said earlier in the course of the presentation, our view is that the current encumbrances being reported in the movement of crude oil, particularly from the relevant stations to where they will be moved onward for processing, is a big concern that will hamper volume within that space. I mean, it is easy to look at the OPEC quota for Nigeria and then perhaps think that would drive direction, especially relative to related when you just oppose it with the price reality in the international crude oil market. But ours, right, is not necessarily in that reality, because we have volume concerns that even a spike in price above the $100 level cannot necessarily mitigate. So basically, they expect that the oil space will do that well, and then of course add to the current performance of the non-oil sector, drive the economy towards that level. But the point is, we are being encumbered locally here, and then that means that position is flawed. Hence, our own growth projection for 2022 is still retained at 2.6%.
Thank you, Ayodeji. We're just going to stay with Ayodeji for a second now. We have a question from Ugochukwu Josiah. He says, how do ARM analysts advise their clients as part of continuous risk management? In my experience, I have never received any advice from ARM. I do not also receive stock recommendations any longer. Can you provide some clarity on these two issues?
I guess that's quite unusual within the context of what we do here every day, because at every point in time, when there are economic events, we try as much as possible to shape our client base view, and then of course their strategy. Just about 3 days ago, we still released a note on inflation on how we think our investors should go about managing their investment position, and then of course, overall strategy in the note. So I would advise that the client, the audience who just spoke to that should please provide their email so that we can perhaps recheck our database to be sure that they are here with us on the database. I think if we get that, then we can always, you will always get our update as and when there are earnings releases from companies, when there are economic releases, and then of course, quarterly, and then biannually. And then of course, we also do annual releases to guide strategy, particularly for the upcoming year. Thank you.
Thank you, Ayodeji. For the next question, we have Andrew SNN. He says, good morning. What is your benchmark return for the Eurobond? I thought the minimum investment was $200,000. I believe Joshua would like to take that.
Okay, so let me answer that. So the minimum benchmark, or I would say the ticket size, the standard lot size for Eurobonds is $200,000. However, we've seen requests from clients looking for opportunity where we can pull investors' funds together. So, say for instance, you have $50,000, $100,000. We can create a structure where you can still invest in Eurobonds. So in terms of the rate of return on Eurobonds, I would say that depends on market realities, because we have different, it depends on what you want. We have Fgn Eurobonds, we have corporate Eurobonds in the market. So it's something a discussion we can take up further beyond this forum, and we can let you know the different type of Eurobonds that we have, because different rates apply depending on what you want, whether it's the federal government Eurobonds that you prefer or the corporate Eurobonds.
Thank you, Joshua. For the next question, we have an anonymous attendee asking that for the mutual funds, especially the money market fund, what can we say is the reason for the daily declining interest rates?
Okay, so for the money market fund, so a large chunk of that fund is invested in T-bills. So that's why you see that downward trend, because Treasury bill rates are not so high at the moment. It's affecting the money market fund. That's why you see that downward trend. But the fund is actually still doing higher than current T-bills rates because of the investments that have been put into the fund. Because of the 91 days T-bills that the fund had invested in at the time when the rate was higher than it is now. That's why you see that it's still higher than T-bills rate. But that's basically, to a large extent, why there's a downward trend in the fund.
Okay, so also to add to what Chinedu had just mentioned, one of the reasons why we saw the downward trend in interest rates is because of the maturities that we had in Q1 2022. I think in total, we had about 3.3 trillion naira maturities when you look at the maturity and also the OMO maturities. But we expect a bit of reversal in yields when we look at Q2 and also the rest of the year. For instance, in Q2, expected maturity is just about 1.2 trillion, which is about 50% compared to what we had in Q1. So I think that speaks to the main reason why we had declining yields for the first part of the year.
Thank you, Joshua. Unfortunately, we've run out of time and we will be unable to take all the questions during the session. But if there are any questions in the Q&A box, we will respond to them privately. We just like to move into the closing remarks for the day, and then we'll just close out the session and we will get back to everyone who had a question. You can go ahead, Joshua.
Okay, so once again, thank you everyone for staying with us throughout this webinar. We really appreciate you joining us. One second. I think in a nutshell, the message we have been trying to pass across is that based on the current happenings globally and also locally, there's need for us to pretty much just rethink our investment strategies as it relates to our investment in the Nigerian capital market. We might not have control over some of these events, but I think we have control over how we respond to them, how our investments react to some of these volatilities. And I think this slide pretty much just encapsulates all that we're trying to say. We're trying to preach a well-diversified investment portfolio. And I think a lot of times what we do as investors is that we look at a particular asset class and we diversify within the asset class. Well, we think that it's very important for us to just look beyond just a particular asset class and diversify across various asset classes. And I think we've pictured about 5 asset classes here. And we also have the alternative asset class. And I think a case in point would be the derivative product that was recently launched on the Nigerian exchange. And I think that pretty much just improves the wide array of asset classes that we have advantage, that we can take advantage of. Yeah, so I think we might not be able to maybe fully discuss how we can build the diversified portfolio at this forum. It's a conversation that we might have to take further because it depends on a number of considerations, such as time horizon, objectives, risk appetite, what you're looking to achieve, and those conversations, we might have to tailor them to your unique investment needs. So I think we would like to hear from you. You can reach out to us if you need more information. And I think the beauty of it is that ARM is well positioned to help you or to guide you through this process, to help you build a well-diversified portfolio. ARM Securities, along our other subsidiaries, we are able to leverage that group structure to help you achieve this objective. So I would like to say thank you very much. You can send us an email if you need further inquiries. We'll be happy to respond to you. Thank you and have a great day.
Thank you, everybody, for coming. The email is on the screen if you have any questions. And we will make sure to answer any of the questions that are left behind in the Q&A box. So we'll respond to you directly. Thank you once again.